Good morning, everyone. Welcome to our webinar today. Delighted to see a lot of you have already joined. We've got a few waiting in the meeting room. This always throws me when I start these things because even though it says I'm unmuted on the screen, it says I'm muted. So somebody wave at me if you can't hear me. Welcome to our webinar today. Delighted that so many of you can join us. We have a lot to get through today, so I'm going to start with a few housekeeping things. First of all, we will be recording this, so if anybody wants a recording afterwards, and we've had some people who said that they can't make it but they'd like to see the recording, we'll be sending that round afterwards as well. My name is Claire Watkins. I am a partner in Buzzacott and I head up the professional practices team. So we look after a lot of law firms, but also architects and chartered surveyors and various other professional practices, a lot of LLPs, partnerships, and also limited companies these days as well. We're welcoming questions using the question and answer thing. If you'd like to send through some questions, we've had some that have come through beforehand and we've incorporated those as best we can into what we're talking about. If we don't manage to answer all the questions, please don't worry, we will come back to you separately because we're a little limited on time, so we might not be able to get through everything, but we'll do our best. So our webinar today is all about modernising your law firm to make sure that it's in the best possible position for long-term financial resilience. And all the topics that we do on these webinars are really drawn from what our clients are talking to us about. And this is something that since the pandemic, firms have realised that they need to be more resilient. Some have become more resilient, and we've certainly seen that. But you can always be more resilient, and it's something that we've been talking to clients about for quite a while now. So we'll be going through the areas that you can employ to make your business more resilient and how we've seen firms do that, along with some financial red flags and things that you need to have a look at to make sure that you're aware of where the danger points are in your business and the pinch points for cash flow and things like that. And we're going to also explore the fact that it's not just good enough to be profitable these days, but you need to be planning for succession and also planning to make your firm attractive to the next generation. We're going to run another series of these webinars, and we have been doing a previous series as well over the next 6 months, and we're going to concentrate on the topic of modernising because we think it's something that, that firms seem to want to hear a lot about. So let me just introduce our panel. So our panel comprises Catherine Edwards, who is a senior manager and has been with Buzzacott for over 10 years. She works on the business side of things, so she looks after the accounting and audit and solicitors' accounts rules and the business aspects of everything to do with law firms, as well as other professional practices and other businesses generally. So she does a lot of work with cash flow planning and consultancy projects for firms that are looking to make sure that they're resilient and make sure that their succession plan is in place. We also have Anna Louise Shipley, who is a senior manager who works, her expertise is in corporate finance. So she's somebody that we call on a fair bit to help us when businesses are looking to change or restructure, or again, that succession word comes up. She's very knowledgeable in how to help firms through a change. And then we have Jessica Beer, who is a tax manager. So her specialism is business and personal tax. She is a qualified accountant as well as a qualified tax advisor. So, but her emphasis is on the tax side of things, and she regularly helps partners who are new to self-employment and who are trying to navigate the incredibly complex tax system. I think Jessica is struggling at the moment to get online. We had a message a bit earlier. She's got a few IT problems, but we'll carry on and hope that she can join us a little bit later. And then behind the scenes, we have Chloe and Leanne, who are from our marketing team, and they are production managers for this whole thing because we really can't be trusted to do any of the behind the scenes stuff when it comes to these things. I should just warn you that the camera, when we use a Teams webinar, is not particularly quick. So when somebody starts talking, you'll find that there's a couple of seconds delay before the camera moves across, but hopefully that won't put you off. So let's kick off. We had some. We sent out a survey beforehand, and we've had a few answers that have come through on that survey, which was very interesting to see. And as I say, we're going to weave that into what we're talking about now. But before we go to that, I just wonder whether we can go to Anna Louise first. And just briefly, Anna Louise, do you think you can look back with the benefit of your corporate finance hat over the last 18 months or so, and just give us the benefit of your experience and talk us through some of the ways that businesses generally, not just law firms, but businesses generally have demonstrated resilience, so that we can perhaps have a look at some of the key lessons that we've learned from the last, well, actually it's not 18 months, it's more like 2 years now, isn't it?
Yeah, absolutely. Thanks, Claire. So I think first port of call is to really say that if you have made it through the last 18 months, that's a real testament to the underlying strength of your business. It already demonstrates that you have resilience within your business. I think normally in these sort of the boom and bust cycles we see in the economy, that weeds out the weaker businesses and really shows the strength of the remaining businesses. And actually, COVID and the pandemic did that for us as well. So I think that's a really important point to sort of give confidence in what you've achieved and how you've got to this point already. I think when we first addressed COVID in spring sort of 2020, there was a lot of uncertainty, there was a lot of panic, and I think actually most businesses were more pessimistic than we sort of in hindsight know they needed to be at that point. We didn't know what it was going to look like. We didn't know how things were going to pan out, and there was a lot of time spent sort of reassuring people and looking at businesses and looking about how they were able to manage the next few months or year or so. I don't think we all quite realise how long this would take at that point, to be honest. And we did a lot of education around the various schemes that were in place, be that furlough, VAT deferral, CBILS, etc., and how best to utilise them to make sure the strength of the business remained throughout that period. I think what we saw actually was that the use of schemes like furlough was really helpful for businesses because it meant that you could bounce back more quickly. So as opposed to making people redundant, those furlough positions meant that as there was a recovery or as business could return to some sense of normality, businesses were able to return to that much more quickly, because rather than hiring again, it was bringing back existing staff who were in place and ready to run. So that was really, really positive. And I think that was part of our overall view of this period was actually, although there was a lot of adversity, there was an opportunity within this for businesses. And the very best businesses, and to be honest, the businesses which are probably in a really good position now or in a better position than they thought they might be in now, are those that managed to utilise this adversity as an opportunity. So I think some of the things we saw were cost saving measures, which perhaps you wouldn't normally have the opportunity to look at, or they'd be put on the back burner, they're not necessarily the top priority, became a really, really important factor in the business. So we saw a lot of businesses trimming the fat and adjusting how they looked at things, whereas previously those costs and things might have just kept running alongside the business without much attention paid to them. But also almost more than that, it's how businesses have pivoted. So I think even in my own team, so as Claire said, I help businesses through times of change. Quite often that might be succession planning, that might be transactions. Actually, people were a bit too nervous to be doing those sorts of things. And so we were helping our clients in a very different way. And I think that's the same to be said for most businesses. It might not be that you were doing the usual type of work. You might have been assisting people in different ways or dealing with different matters. But I think those that were able to pivot and adjust and actually support, it might be that you're able to support more remotely or offer them different kinds of support. That was really, really important. And then I think coming back to sort of the key theme of the webinar, particularly we saw in sort of professional practices firms, people saw this as an opportunity to modernise. I think there's been perhaps a bigger weighting on paper-based work and not quite the digital transformation that we've seen in other industries, but definitely in law firms, we've seen it in architecture practices, etc. The willingness to be more agile now, to allow some working from home. Obviously that was compulsory for a time, but to see how that could be utilised to the maximum efficiency. We've seen law firms actually use that really, really well. And use tech to their advantage, whereas I think previously it was a more traditional view for many people. So that's ways we've seen our clients really benefiting from this, and actually it's set them up for the future really positively.
Thanks, Anna Louise. That's great. Yes, I would reiterate, I think law firms have done incredibly well, given that they are so paper-based compared to other businesses, and they really did do incredibly well getting up and running remotely as fast as they did. So, Catherine, let's move on to you. I mean, you and I work with a lot of law firms and have done for many years, and of course, law firms have been around for, well, forever, so they are inherently resilient. But they're able to make themselves even more resilient when faced like a crisis like the one we've just emerged from or are emerging from. Can you just talk us through some of those elements that you've seen of resilience and how the best forms of resilience, you know, how you've seen those in certain firms?
Yeah, sure. Thanks, Claire. So the law firms that we look after, they tend to be collaborative. So the income streams that have struggled, so the transactional work, corporate commercial deals, residential conveyancing, they obviously largely went on hold from the start of the pandemic for that 4 or 5 month period in 2020. They were supported by the more resilient legal areas like private client, family law, probate, wills that operated really well in that tough time. Obviously, that was difficult for the very small, niche, specialised firms. But while we saw a slowdown for that 4, 5, even 6 month period, September to December 2020, there was a lot of pent-up demand, leading to a real sort of bumper end of the year. So we saw a recovery at the end of the year and a successful end to the year. So, I mean, fundamentally, lawyers offer services that clients need. They can't get those services elsewhere, so there was still demand for legal services. As I said, the more collaborative the firm, the better. The firms that operate in a true partnership style worked much better than those operating as a group of sole practitioners. So those sort of, when I say a group of sole practitioners, I mean lawyers operating in a silo who are just very focused on their own chargeable hours, their own billing, not really working as a team. So the firms where partners worked together to lead the business and come up with a strategy and a plan to pull through, those were the really successful ones. Quite often, law firms have a good relationship with their bank, and that starts quite often with partners borrowing capital. So the partner capital loans, that's kind of like the first foot in the door to a law firm building up a really good relationship with their bank. And this was really useful at the start of the pandemic because it meant that they had that kind of emergency funding which they were able to get from the bank. So a lot of the law firms that we look after were really successful at obtaining the CBILS loans. In contrast with those that had no previous track record with the bank, they struggled. Bearing that in mind, however, a lot of businesses, not just the law firms, but a lot of businesses we've looked after haven't actually needed the CBILS loan, and they're now looking to repay early. But I mean, that's a great position to be in. Obviously, it was a nice safety net to have at the start of the pandemic when there was a lot of panic and uncertainty. No one knew what was going to happen. So having that access to emergency funding was great. And so having a strong relationship with your bank is more important than ever. A lot of law firms as well are well capitalised, and that's great. It means there's some wriggle room if cash flow from clients does get a little dry for a certain period of time. Those firms that were already pre-pandemic relying on large bank loans and overdrafts, they were the ones that weren't resilient enough to pull through, and now possibly looking to merge as a result. But it wasn't as a result of the pandemic itself that they've struggled. They were, struggling before. They were already very reliant on external funding. And generally, we found that most businesses haven't failed as a result of the pandemic itself. If you were doing well before, then you've tended to be resilient enough to pull through the pandemic. Just to sort of reiterate what Anna said as well about trimming the fat. So the issue of maybe underperforming staff or underperforming partners, that could be addressed as a result of the pandemic. And it might have been something that some firms were brushing under the carpet before, but the pandemic kind of brought it to the fore, and businesses had to deal with some cost savings. So yeah, it kind of just forced some change, really. That was it really on that.
Okay, Kat, thank you. Yes, just your comment about brushing problems under the carpet. That is something that I know I've mentioned it on previous webinars, so apologies to anybody who's attended other ones and has heard me say it, but it's a sentence that's been said to me many times that, oh, Claire, the pandemic's forced us to look at issues that we've been brushing under the carpet for years, and we certainly did see that. Catherine, can we just go back to you for a second? How can law firms make themselves even more resilient? I mean, we've noticed a few weaknesses from a financial perspective, either in the short term or the long term. And what we quite often talk to clients about are what we refer to as red flags, especially to newer partners who are looking at their management accounts and their firm's financial data for the first time. You know, they look at a set of numbers and they don't always know, and why should they? Well, that number there is a red flag and I should ask about that. What are the sorts of things that you talk to clients about, you know, from the red flags perspective?
Yeah, sure. Yeah, so I'll start with the red flags or weaknesses in accounts. So as I've sort of already mentioned, really, reliance on bank overdrafts, large external bank loan balances, i.e. a worsening cash flow cycle that's eating up cash rather than a positive cash inflow. So that's a definite red flag if we're seeing a negative cash balance and large bank borrowings. One thing that obviously feeds into that is the slow conversion of profit into cash. So a large trade debtor balance and a large work in progress balance, those would be red flags. So you've done the work, the hours are on the clock, but how quickly are you then able to convert that into a bill that gets sent to a client, and then how quickly are your clients paying you? If we as accountants see large WIP or trade debtor balances, we're immediately thinking, is that really recoverable? So the trade debtor and the WIP figures in the accounts, that should be the recoverable amount. So I would be thinking, has a bad debt provision been included? Has a WIP provision been included? Quite often we see bad WIP being carried forward. So is that WIP really billable, or should it be written off? The older the balance becomes, generally the less likely it is that it's going to be billed. Obviously, certain type of legal work, there's more of a delay in terms of how quickly you can convert that WIP into a bill. It depends on the type of legal work, but generally the older it gets, the less likely it is to be billed. But obviously you'd need to assess on a case-by-case basis. So another thing to think about if you're looking at a set of accounts is, have all provisions and liabilities been accounted for? So a good example here might be a dilapidations provision. So a lot of businesses fail to account for this correctly or account for it at all. So you'd need to check your lease, but if you do have an office lease, generally you're required to put the property at the end of the lease back into the condition that it was when you took the lease out. So for example, if you've put in internal partitions or something like that, you'd be required to make that good at the end of the lease, and the cost to do that you should be recognising upfront and then releasing over the lease term. Just another thing to think about is, are there any other hidden liabilities or provisions? So are there any legal claims against your law firm? Something like that, you might have to include a provision in there if you're expecting to make a payout. So that should all be accounted for upfront as soon as it's known about, really. Next red flag I was just going to cover was overdrawn partners. So partners who owe money to the firm rather than the other way around. So normally a law firm would owe partners money, but if it's the other way around, that's a definite red flag. So this often happens if profits fall below what was kind of budgeted or expected. So your profits are lower, but you haven't adjusted your drawings, so you're still paying out drawings, but the profits aren't there. So really, drawings should only be paid out subject to cash flow availability, so that should be reviewed on a regular basis. If partners are overdrawn, then you'll need to implement a plan to bring them back into a positive figure. That's a definite red flag to the bank. If the bank sees a set of accounts and sees that partners are overdrawn and living off profits not yet earned, that's a definite red flag. Especially if you've got partners that are sort of close to retirement or looking to exit or leave. If they owe money back to the firm, even though it is due back to the firm, quite often it doesn't get paid back because they just sort of form an agreement that it's just easier to just leave it. So you don't want to get into that position in the first place. The final red flag I was going to cover was just around tax reserves. So probably around 50% of the law firms that we look after reserve for tax within the business. So they pay their partners their profits net of tax. That money ultimately is due to HMRC, so really it should be ring fenced. It shouldn't be used as general cash flow for the business to sort of use. So yeah, if you've got tax reserve money that's being used as general cash flow, then that's another red flag.
remember is if that money is used for working capital such that then there's ever a shortfall with HMRC and the money that you need to pay over to HMRC, then the individual partners will be asked by HMRC to pay out of their own pocket any shortfall, to make up the difference of any shortfall. So it's really important that as an individual or a member of a partnership, or a law firm, you need to understand what the procedures are, where the money's being kept, and what's being done to ensure that it's not being used for the day-to-day capital, so that or not for the day-to-day run of the business, so that it's that it's going to be there to settle your liability. And you see a lot of people fall down on that, especially in years where profits go down, which in the last couple of years, or given the pandemic, we have seen a little bit of. So it's just to make everybody aware so that they know to watch out for it.
Yeah, Jess, absolutely right. And I think later on in this, we're going to squeeze in a topic quickly that Jess is going to cover to do with the change in the basis period review for tax, which will affect an awful lot of firms out there, including our own, any firm that doesn't have a 31st of March year end. So we're going to weave that in because that does have an impact on tax. But yeah, we have seen this time and again, actually, that particularly professional practices that have an April year end or a non-31st of March year end, there is a lag between when you earn your profits and when you pay tax on those profits. And you don't pay tax for quite a while after you've earned the profits. So you have to make sure that you're keeping that to one side. And it is quite difficult to match up when that liability comes through. You think, well, which profits did that relate to? And it's even worse when you're retiring, because even after you've retired, you carry on paying tax for quite a while. Let's just go back to Catherine quickly. I just wondered, you talked about work in progress and debtors and looking at red flags and things. Of course, it's incredibly important when if you're comparing your accounts to another firm's accounts. For example, you're benchmarking yourself against another firm, and I know you and I, Catherine, we do quite a bit of this when we send accounts out to our clients. We tend to, put a bit of benchmarking information in there. Can you just talk us through why sometimes you're a bit comparing apples with oranges, and the way one firm accounts for something may be radically different from the way another firm accounts for something?
Yeah, sure. So just sort of be aware that your accounts, and in particular profit probably is the main thing, can be manipulated just by tweaking accounting policies or estimates just very slightly. So one set of accounts can be quite different to, even for one firm, your accounts could look quite different if you just sort of tweak your accounting policy slightly. So just to give the example of a WIP provision, for example, so one firm might take the approach of anything over 3 months old should be written off. And when that WIP is written off, it would go through the profit and loss as an expense. So that firm would have a lower WIP figure in the balance sheet and a higher expense, so a lower profit figure. Just to compare that with another kind of method, so other firms might carry WIP forward for months, even years, thinking that it will eventually be billed, and only write off WIP in exceptional cases. So in that scenario, the WIP figure on the balance sheet is going to be higher and profits are also going to be higher. Neither accounting policy is right or wrong, it's a judgmental estimate. I mean, ultimately it should be as accurate as possible. So you really do need to go through your WIP on a sort of line by line basis and really think about, is that going to be billed? If it's going to be billed, it should stay in there as WIP. If it's not going to be billed, then it should be written off. But something like this is unlikely to get picked up in your accounts by someone else. It's up to you as management, and if it's your WIP, it's your responsibility to put in provisions and write it off if necessary. So something like that, as I said, isn't going to get picked up by your accountants unless your accounts are audited, and if they're audited, they're subject to a higher level of scrutiny. So the audit threshold now is 10 million turnover, so a lot of smaller law firms are below that audit threshold and won't be subject to an audit. Obviously, the larger law firms will be audited. I suppose the only other thing to just be aware of is the difference between a set of limited company accounts and LLP accounts. So I've been talking probably more around a set of LLP accounts just because the majority of law firms we see are LLPs, but yeah, a set of limited company accounts and LLP accounts will look a bit different, and not so much on the sort of WIP and debtor side of things. It's more the partner accounts, so the capital side of the accounts will look quite different.
Yes, in a set of limited company accounts, you can find that the profit is a hell of a lot less than it is in an LLP set of accounts, even though actually the business is exactly the same. That's because the cost of the partners is a charge against that profit. Catherine and I have seen this quite recently, actually, when it comes to work in progress during the pandemic, when we've been auditing law firms. Over the last couple of years, actually, we've seen that it's come to light that there are certain partners that haven't been valuing their work in progress accurately, and actually, you know, there's been an extra level of scrutiny from within the law firm, so they've had to really look at it and you know, face up to the fact that they can't keep carrying the value forward, because ultimately it's not going to be billed. It's something we all battle with as professionals, isn't it? You know, you overrun on something and you think, oh, we'll get that back eventually, but actually sometimes you just don't. So Catherine, back to you again. We're asking you to do all the talking today. Just going back to financial resilience, give us some practical ideas, practical steps that firms can take to ensure that they're financially resilient.
Yeah, so I think step one really is putting in some really good financial controls and processes in place. So, for example, the preparation of monthly management accounts, or quarterly as a minimum really, and cash flow forecasts and budgets. So as part of this process, so as part of your monthly management account pack, it's really useful to look at some key performance indicators, or KPIs. So traditionally, we find that lawyers are quite focused on chargeable hours, fees per partner, profit per equity partner, those type of metrics. But there's some other examples I can give that can also be quite useful. So overhead rate, for example, so that's a measure of the cost of the services you're providing. So with that, you're looking at your things like rent rates, those type of costs, over direct staff costs, and that can be quite useful in helping you to determine charge out rates and that type of thing. Another ratio to look at could be debt to equity ratio. That can help you decide how to fund your business, whether you should be asking for more capital from partners, or maybe looking for some external third-party funding. And lock-up days, that's an absolutely key metric to look at in terms of managing cash flow. When I say lock-up days, that's the total of work in progress and debtors. So it's basically a measure of how quickly it takes from starting a piece of work to actually getting the money in your bank account. So if you are looking at key performance indicators, it's really important that these are monitored over time. If you just calculate them once, that's just a snapshot in time. It's meaningless, really. So you need to build up that picture of how things are changing over time. And it can also be really useful to benchmark against other firms of a similar size as well, to see how you're doing. In terms of other kind of like practical ideas, so a good question to think about might just be, for example, if work dried up by say 20%, so if your revenue dropped by 20%, how long can you continue to run the business for? So have you thought about this question and prepared cash flow forecasts or contingency plans? And then have you done some stress testing around that? So this is actually something that we see our architect clients do really well. They quite often have a realistic or an expected cash flow, a best case scenario and a worst case scenario, and then do some stress testing around that just to see how they can react if sort of revenues do drop or something like that. With all of this, we think it's really, really important that financial information is discussed within a senior management group to ensure a collaborative approach around financial management. We tend to see two camps, so those that share financial information and those that guard it. Sometimes junior partners aren't even involved, let alone a kind of wider management group. But in our view, if there's nothing to hide, what's the harm in sharing your financial information with a wider audience? Just to give an example, so at Buzzacott, we get sent various reports across the whole team. So we get sent a daily cash collection report, sort of when it gets closer to the year end, billing targets are shared. Each week we get sent a report with top 10 debtors, top 10 WIP balances. Generally, we find it's really motivating and helpful. The earlier you start sharing information with more junior team members, the more interested they become in how the business works, how it's run, and start working their way up the pyramid. And that obviously all helps with the kind of succession plan. Small firms often don't have the benefit of a qualified FD, that's where it becomes really important to engage with your external sort of expert advisors who can perform an outsourced FD role. So smaller law firms will most likely have a part-time bookkeeper who's able to perform the day-to-day transactional stuff, but they won't have the capacity to look at the higher level, more strategic type financial management. And that's where it can be useful to seek advice from external accountants or other advisors who can act as a sounding board and offer an independent view on your business and might have sort of some different ideas to help. So sort of going back to the pandemic, and obviously previously law firms have been very focused on profit per equity partner, that type of thing, but the pandemic has taught us that cash is king. There's a greater focus on cash flow now more than ever. I was just going to run through a quick example, and I hope you're able to follow this without it kind of being written down in front of you. But so I was just going to give an example with a 5 million turnover law firm with a lockup balance of 1.5 million. So lockup would be trade debtors and WIP. If you do the calculation, that equates to 110 days to convert the work performed into cash received. Just put that into context, and the average for a 5 million law firm is 153 days. So that's actually 5 months from starting a piece of work before you get paid. With that example, 1 day equates to £13,600 of cash, which is locked up. So if you can reduce your lockup days by 10 days, that would release £136,000 in cash. So that's just an example, just to show you how important it is to try and speed up that cash flow cycle, to try and increase the speed at which you can get the money into your bank account. And in terms of practical steps as to how you can actually improve your cash flow, well, obviously the best way really is to have a dedicated credit control function. Obviously the larger firms will most likely have a special credit controller. Smaller firms might not, but one example could be to have a credit control day. So have 1 day of your finance team dedicated to just collecting cash that day, and chasing clients, trying to get hold of the cash. There's kind of pros and cons of whether it's best for your client relationship. So the partner or the manager actually who has the direct contact with the client, whether it's best for them to chase or whether it's best to kind of separate it a bit and let the credit controller chase. We sometimes use the technique of blaming our credit control team. So I might call a client and say, our credit control team's really chasing us, please can you pay us? But equally, sometimes it's a better approach for the credit controller to speak to the client because they can have that kind of more direct approach. Again, just coming back to Buzzcott and some of the things that we do. So we get sent a monthly report with any debtors over 3 months old. So that's just kind of a gentle nudge. You kind of don't want to be on the naughty list, so sending out an email like that just helps give you that nudge to chase some cash. As I said, we get sent daily cash collection reports and those weekly top 10 debtor reports as well. So they're just some kind of like gentle nudges that we find are quite useful. It gets everyone involved in running the business from an early stage in their career, which again can be quite motivating and helpful with the kind of succession planning as well. So but there are some external ways to manage your WIP as well, and I think Anna Louise was just going to explain some of that.
Yeah, I'm very happy to pick that up. It's slightly different approach to the sort of practical steps that Catherine's mentioned there. One of the things that we look at with clients who typically end up with large debtor balances, who typically are the law firms, professional practices, are external sources of finance. And the one that sort of works particularly well here and matches against debtor books is invoice financing. I think important distinction to make is between invoice financing and debt factoring. I think debt factoring is the source of finance most people are more familiar with, which is where an external financer would essentially take on your debtor book. They'd collect those debts, they'd take their fee and they'd pay you the remainder. Invoice financing is, I think, a bit of a softer approach in that it's secured against your debtor book. So to all of your clients, they have no knowledge of this financing function whatsoever. So your debtor book acts as a security against any debt raised. So what they'll look at is if you've got £500,000 worth of debtors, for example, they will loan you an amount against that debtor book. It might be sort of 70–80% of that debtor book. And that will flex depending how many debtors you have in place at any one time. So if that debtor balance drops down, your facility will drop down. So it can be a really nice measure. I think important to mention, WIP can be part of this. It depends on the provider and it depends on your WIP. Coming back to Catherine's earlier point, it has to be a good, strong WIP balance. It can't be sort of old balances that there's uncertainty about. It needs to be proper WIP. But the debtors are the easiest way to do it because there's a clear contract there and there's a clear collection process. But it is a nice sort of alternative way of raising some finance. And if you have a really strong debtor book and you know your clients always pay but they're just a bit slow, it's a really great way to release some cash flow.
Cool. Yeah, that was all I really had to say in terms of the practical steps. The only other thing I was just going to mention was sort of law firms have had to maintain their visibility during the pandemic, as obviously the traditional networking opportunities haven't been available. So they've had to start becoming more forward thinking in terms of moving away from we have to cut costs to how can we get new business in. And that obviously has been more challenging with the pandemic because all of our traditional networking opportunities haven't been available. So it's just been about maintaining visibility. If the top line keeps increasing, then the bottom line tends to take care of itself. So it's generally not acceptable these days to just sit with an in-work of tray. It's all about getting in front of people, trying to get yourself known, and you know, that's obviously part of the succession plan as well, getting the more junior members of staff involved from an early stage in business development and networking and things as well. So, and I think Anna's going to talk a bit more about that as well.
Yeah, oh, sorry, Anna, I'm probably cutting across you. I'm just conscious of time. So what I was going to do is go to Anna Louise and just ask you to talk a little bit about, because one of the topics of this was making the firm more attractive for bringing in other people, basically, for attracting new partners. And Anna Louise, you had a few comments to make on that. I just wonder whether you can go through those fairly briefly, and then we're going to go quickly to Jessica, because I just do want her to cover the tax element. Is that all right, Anna Louise?
Yes, I will do a whistle stop tour on this. So I think there's two sort of prongs to it. So there's the existing sort of senior leadership or management in your firm that can come up through the ranks and how to get them properly engaged. And then there's external potential partners as well. So picking up on a point Catherine made earlier was around actually including management earlier on. So whether that be through financial information, having their engagement, having their understanding earlier can actually help them develop more quickly. So because I think part of the fear can sometimes be actually, are they ready to take on the role? And there are several ways we think that you can help management prepare for the role, but also to get them properly engaged and sort of really excited about that. So simple things like making sure relationships are multi-touch. So I think it's quite natural that people want to hold on to relationships, and I know with my clients, I love my clients and I want them to be mine, but it's really important that throughout the different levels in the firm there are relationships there. So it's a relationship held by your practice, not by one individual, and actually then when succession happens it's a lot easier rather than it being the one person the client knows has moved on. I think there's also the sort of external partners, and it does overlap certainly, but understanding that there's value being built in a business is something really attractive. The business is going somewhere, and I think we touched on this earlier, but I can't stress how important pipeline is and looking forward and not just looking at how the business is today. It's, you know, actually your business is worth what its future profitability is, not what its past profitability is. So really the value of your business is in your pipeline. And I think really there's making sure the partners that are existing are passing across their network, their mentoring. They're just, you know, that the key partner shouldn't just be assessed on their billing. It's how they're helping the next generation prepare to run the business. So I think that was a very, very brief overview, and we could run a lot more detail in that, but
Thank you. Yes, we made this a 45-minute webinar, and we could do with it being an hour, but we'll pick up on some of these other points another time. But Jess, can we just go to you quickly, because for the next generation of partners coming through, if they're offered partnership, is there anything that they should be looking for in the firm's finances, or anything that they need to think about from a tax perspective? Because we do get asked this an awful lot.
No, I think that's a really, really good question. In terms of looking for things within the accounts and at the finances. It's just really about having a general understanding about the business. I'm not going to repeat some of the things that Kat said earlier, but all of that is really important in being able to assess whether the firm is doing well and actually want to be a member of the business, or it's a business that what you want to help succeed and to keep on growing. What I will say is that, other than the tax reserve stuff, it's all about making sure that they're comfortable. Anna Louise and Kat both mentioned that it's about working collaboratively, making sure they're part of the group, understanding that it's the profitability of the firm if profits go down, it doesn't necessarily mean the firm's had a bad year. They've just had a lot more expenses, or something. They might have moved offices, so it could all be positive change, but that could affect the profits that go up and down. And it's just about making sure that you understand the business as a whole, and you're still involved with, or perhaps you get more involved with the top line decision making within the firm. But I think naturally you would do so anyway as part of that promotion. In terms of, is there anything that you need to be particularly aware of? Most law firms that we work with won't have a 5th of April or a 31st of March year end. So you may or may not be aware, but they're going to get rid of the basis periods, or align. HMRC have recently released a consultation and put it into legislation that they're going to align the tax basis periods with the normal tax year ends, which essentially would mean for new partners, it will be a lot easier going forward. They will just have the amount of profits that they'd earned in that particular tax year that is subject to tax in that year. In terms of how we actually collate those numbers, is going to be a very strategic business decision, because it may be, if the firm doesn't want to change their year end, which is definitely a conversation that should be brought up in meetings, then we'll have to, for tax purposes, take a portion of 2 sets of accounts and merge them together. So then it will mean that reporting and recording and making people aware of which profit relates to which year is going to be a bit more complicated. But in terms of the money that you receive and the money that's being taxed, it should be a lot more in line with someone's actual drawings, their month-on-month drawings. So, which is a common mistake that we usually find when partners are first promoted. They don't understand, or it's hard to go from being an employee whereby you receive your monthly salary and it's already had tax deducted at source, to then receiving a monthly draw which actually has not yet been subject to tax, although some might have been kept to one side. But it's your drawings aren't the bit that's taxed. It's all connected with the accounts and the bottom line figure within the accounts and your taxable profits after certain considerations are taken into place. It's more important for these changes are more important for existing partners. They're going to come into effect from 22-23, and there'll be a hybrid year whereby any overlap that has previously been crystallised, which is essentially profits that may have been taxed twice in the first year you became a partner, they will crystallise and be utilised in the 23-24 tax year, which is going to be known as the transition year. That may result in cash flow issues for certain firms if their profitability is going to continue to go up. There may be additional profits that are subject to tax. HMRC have said that they will, or their proposal is to split any additional tax charges as a result of this change over the course of 5 tax years. However, we're yet to see how that's actually going to work in practice, and how they're going to let us determine those figures. So at the moment it's all up in the air. There is some stuff in legislation, but it's definitely a watch this space and make sure that you're aware and you plan for everything going forward if you can, as much as you can.
Sorry, Jess, thank you so much for that. We're about a minute over, I think, but yes, I mean, but basically the law firms, well, LLPs and partnerships, including our own, are probably going to end up changing their year end to the 31st of March. That's really what it boils down to, which is something that firms need to plan for. I think we're out of time. There are various points that we're going to pick up on our next webinar, so we will circulate that when it's planned. It won't be until January, if not beginning of February, but we'll let you all know. Thank you very much for joining us. If you have any queries, do please get in touch with us and we'll reply individually to you. But thank you everyone. Thank you to our lovely panelists and to Chloe and Leanne in the background for managing the production of everything. And we'll have a lovely Christmas and we'll see you all in 2022.